Here we go.
Go.
And we're here.
All right. Welcome back for the 15th time. We'll pretend like nothing went wrong and we had to start it over 45 times in the last 36 seconds.
Sure.
Because we're professional like that. We'll play it off like nothing happened.
Yeah, right.
Because of our vast broadcasting experience here, we're lucky we're even on.
We definitely are on now. So what are we going to chat about today, Rob? Fill us in.
I was thinking we talk about non-owner occupied property or real estate investment property or rental property, whatever you want to call it, depending on what part of the world you're in. And we'll kind of cover how to get into it from a mortgage side versus some of the other sides of it. We're not going to get into asset protection or taxes, but we'll talk about how having your taxes filed correctly could affect your ability to qualify for a loan. So what an accountant does on your tax return doesn't necessarily always help, or what a property owner and an accountant does to prepare the taxes doesn't always help you when it gets time to then later on refinance and you're turning over your tax returns to a loan officer or mortgage professional, as they like to be called because they're so professional. And then they start looking at it and you don't have the income that you thought you would have. And a couple of simple things could have fixed that and increased your income. So I figured we'll go through that, talk about that. And then also talk about how we look at the difference between when we use a rental agreement versus tax returns.
So why don't you just get right into, like, say somebody on their application claims that they make $150,000 a year, right? That might be a gross earnings, right? Maybe they have some rental properties.
Right.
Right.
So I have an example. I took an example of a client of mine, and all the personal information is out of it, but I just have a bunch of numbers here, and I can go through and show you some things that would affect your ability to get a loan. So here, I'm gonna share my screen here. Can you see it?
Yeah, I can.
So this is a standard Fannie Mae worksheet for rental income. And the way it works is, across the top here, you would enter in all of the properties that you have. So here I have P1 through P8. And then on this line item here, I'm going to scroll over because we don't really need to do all of them, but it's a good way to kind of see how it works. Actually, I'm going to change how I share this because I share my screen instead of that because I want to bounce between two different. Forms here. So I also have what's called a Schedule E, and the Schedule E is what. Excuse me, I am fighting the end of a cold. So a Schedule E is what your tax person your accountant and you will fill out. And we'll just go through this really fast first so you kind of understand it. So part one of the Schedule E is the covering for rental real estate. And you're going to go through and answer these questions. And I'm not going to tell you how you should answer them. I'm just going to tell you that they're there. And then down here, when you start to get into your property, so you have property 1 under A, property 2, B, C, and then if you have multiple properties, you just keep regurgitating this form and have the same form used over and over again. And then you're going to list out under B1, you're going to list out what type of property it is. Is it a single family? Is it a multifamily? Is it a commercial? On and on and on. And then over here, this is the most important thing, which is fair rental days versus personal use. So fair rental days is how many days the property was being rented and you were receiving rents on it. So if your property is staffed for 2 months, let's say somebody moved out and you had a month worth of rehab and they had 2 months to find another person, then you would subtract 90 days, or maybe it was 45 days by the time you got a renter in there or whatever. You'd subtract those days out of 365 to get your fair rental days. The other thing is if you had days where you rented below market, you would not include those. So let's say you were doing a special favor for somebody, like you had a friend that needed a place to stay and you're going to let them stay there for 30 days and only charge them $1,200. Then you would not, generally, you're going to need to talk to your accountant about this, but generally those days don't count to fair rental days. They may fall under another category. But this section here under fair rental days is important. That's why I have it highlighted. And I'll show you why on this form here. So on this form, wrong way. So on this form here is where you put in your fair rental days under, and then the property was in service. So if it was 12 months, you'd put 12 months. If it was 10 months, so on and so on. Follow me?
Yes.
Do you like my, can you see my drink? Okay. So then what we do is, then you have total rents received. This is max rents you receive minus any deductions. So let's say you charge $2,000 a month, but you have a management company that takes $200 of that. You would still put the $2,000 per month there. Because down here, lower down, you're going to put under section 11, you're going to put the management fee. So you're going to want to put your 2,000 times 12, which would be 24,000. And then for management fee, let's say they took 200 of that, then you would have it down here under 2,400. See what I mean?
Right. 200 a month times 12, 2,400, because this is an annual basis is what you're saying.
Correct.
Got it.
Correct. And then, so with your tax guy, you're going to go through and you're going to line item out all these different costs. You'll notice that I only have certain ones that are highlighted. And these correlate with what we will actually use when we're establishing what your rental income is on the property. Follow me?
Mm-hmm.
So if we go over here and we look, we have 12 months here under investment property for column F. And then under A1, this is Schedule E, Part 1, Line 3, which is the rents, total rents received. We have 23,363 is what was received for this property, correct?
Right, I see that, 23.
Yeah, then what we're going to do is, I wish there was a way. Hold on, let me make this just a little bigger. If I make it a little bigger, will it make it easier on you?
There you go.
So then what we're going to do is we're going to jump over to line 20, which is total expenses. And we're going to pull this number here and bring it over here and put it under A2. And then it's just a simple jumping back and forth. So then we're going to go to line 9 for insurance expenses. And we're going to go here. And the reason I'm pointing this out is it's really important. I'm not suggesting that you put anything in these categories that don't belong there, but it's very important that you put these items in those categories, because these line items are getting put back into your income. So what happens is on this form, we have the gross, we have the the gross rents, and then we have the total expenses, and that subtracts out. Okay, so this is subtracted from this. Then what we're doing is we're going back in and we're adding back in the expenses to add back into your income. Follow me?
Yeah, that they allow. The expenses they allowed. Yeah.
Right. So if you're lazy and you leave something out or you put it on the wrong line item, which happens a lot of times, which this is what I see a lot of times is somebody will take it and they'll jam it down here under other, or they'll jam it into another line item because they just don't feel like, oh, it doesn't matter. As long as I get it in there, it doesn't matter. But so insurance, mortgage interest, paid to banks, taxes, this is your property taxes on the property. Very important to get that in there. Depreciation, this is huge because generally this is the biggest number that goes back in. So if you notice, like on this property, mortgage interest was $6,000, taxes was $22. Homeowners Association, I'll go over that in a second. I'm going to jump over, but depreciation. This person is really conservative. Generally, this number will be like $10,000 usually, because they're accelerating their depreciation on the property a lot of times at the beginning of the property. So this number will usually be a lot more aggressive than this. And I don't know why this client's is lower, it just is, but most times this number is usually a lot higher than it shows on this one. So I don't know if they're using a different form of calculation for their depreciation. I'm not sure what they're doing. But it's important that you're being as aggressive as you legally can under depreciation so that you can have that added back in. Homeowners expense and one-time extraordinary expenses. So mass casualty, you have a fire, you might even be able to get away with a major rehab on the property. So maybe you add in, you do an addition to increase the room size, or the doors on the property. Maybe you take a single family and you add it to you add an ADU to it. So these are one-time major expenses. That's where they would go, and that has to be. You can't just go to your form here under other and just list them out and put a total there. When you're doing this other, you actually have to do an addendum to this and include the addendum with them and line item it. So if you're line iteming out, you'd have one, if you have an HOA, you'd have a line item with your HOA costs. So if it's $100 a month, it'd be a total of $1,200. You just say HOA $1,200, and then the next line item would be, fire, fire repair, and then you put $20,000 or whatever it was, or major remodel or addition or something. You'd list it out that way. And then any other expenses that didn't fall under these other categories that are in here, you would list those out too, because then the reason we need that is we're not going to add those additional expenses because they may not be allowed, but we're definitely going to add back in the HOA and then the one-time extraordinary expense. So then all that gets taken down here, and you get your adjusted gross income, or your adjusted rental income, sorry, not gross. And so that's a big difference between 363, 67. Now you're at, so this is your what you actually get to use as income. Then we would divide it by the number of months it's in service to come up with your adjusted rental income of $1,337, right?
For the monthly, right?
Correct. And then under the next line item is what we enter in there, which is your PITIA, which is your principal, interest, taxes, insurance, and then other like HOA or other things that can be added back in. So on this house, they have a total PITI of $1,295. And you subtract that from your total, and as a result, you're getting a plus $42 on this property.
So $42 is the only amount you can use as the rental income?
No, so it's a little different than personal income. So when you're using personal income, you take that income, you add it up, and you throw it under your employment income on the 1003, correct? And then that is used against your monthly expenses. All right. And you come up with a debt to income ratio that's like 50% or 30%, right?
Right.
But when you're doing rental property, you actually get you get to handle it differently. So this is applied dollar for dollar to it. So what you're actually getting here is you're getting $42 to add over to your personal income against your personal expenses. And we've completely washed out on this property your rental property expense towards your DTI. So this line item here on your debt to income ratio will show as not a loss. So when you're looking at your liabilities pay section of the 1003, it's going to show as a positive $42 instead of a $12.95 expense. Follow me?
Okay. Got it.
Right? Okay. Whereas if you didn't have that rental income, it would show as an expense of $12.95.
Right.
Okay. Now here's the thing. On this property, I can tell you right now, the rents on this property are more than $2,400 a month, which tells me that this property was not rented for 12 months.
Exactly.
How do I know that? Because just 10 months of rents would be $24,000. So this property sat at least 2 months without being rented based on this. I just know that because it's simple to do the math, right?
Mm-hmm.
Either that or he understated his income, and then that's a whole other issue. But I'm not suggesting that he's understating how much he made. I'm stating that he didn't properly fill out this step one up here. So this is where it's really important on your Schedule E that you're filling out your fair rental days. So instead of 365, excuse me, he should have had in here 305, 305 days. Or maybe it should have been, because it's a little less than 2,400, maybe it should have been 295 days or something, right? Because it's been 70 days empty. Follow me?
Right. Yep.
And here, so now I'm going to go back to this form and I'm going to show you something. I want you to notice what changes when you do this. And this is why it's important to do this. As soon as I go to 10, look what happens to his numbers. His monthly rental income jumped up to $1,605 on that property. And instead of only getting $42 in extra revenue, he got another $310. He got $310.
Mm-hmm.
Can you see why this would be an advantage?
Yeah.
That's an extra $310 of income to go over to his personal income side to go against other debts.
Right.
Now, if you look at these, all these properties are the same here. This one, if you look at it right now in the next column, it's sitting negative $39, right?
Sure. Yes.
And so he would actually have on that line item on his liabilities, he'd be showing as $39 against his PITI. You got it? It's a debt of $39 for that line item. But if he had done it correctly, and because this property is basically the same property and its rent is around $2,400 a month, if he had gone 10 months with that, all of a sudden now he's positive.
Mm-hmm.
So this debt is completely washed out against his DTI, and it's actually adding income back into him. This property, same situation. It was sitting low, and he would have gained another $283 on this property. This property also. So on all of these, he was either negative or $50 plus. Now across the board, he's added $1,400 across the board. $1,400 of profit that could have washed out a car loan.
Right. Yeah, so it's just important to get all the expenses that are able to be added back in the right categories on that Schedule E.
Right. It's understanding why the accountant doesn't care. So when you're talking to your accountant, he's just filling in boxes. He does what you tell him to a certain amount or extent. But he hold on one second. So if you don't tell him that property sat for 70 days, and that's where it's important to have your spreadsheets set up correctly.
Right.
And so when you turn that over to your accountant, he's able to say, hey, this property here was empty for 30 days. This property was empty for 45. This one was 6 months.
Mm-hmm.
And it may or may not affect your taxes, but it sure is going to affect your ability to qualify for a loan.
Right, because taxes is one thing. Qualifying for a loan is totally different.
Correct. And I'm not suggesting that you do something that's going to affect your taxes negatively. It needs to be accurate for your tax purposes.
Right.
But if you're not putting them into the right line items, or you're cheating yourself and you're deducting things, then you're hurting yourself when it comes time to do a loan.
Right. To qualify for a mortgage.
Right. Yeah. Another mistake would be that in the rents, you put down your net rent because you know that your management company takes $200 off the top. And instead of you putting, $24 or $2,400 per month times 12, you're putting, $1,200 per month, or I'm sorry, $2,200 per month.
Mm-hmm. Right.
And showing it as rents received, and he takes it off the top. Like maybe the way you're billing out is wrong. Your rent should be your rent. Your fees should come off after your rent.
Right.
So don't deduct those things out.
So keep it at gross rents before deductions.
Correct.
On your Schedule E. Okay.
Yeah, because if not, what's going to happen is more than likely you're going to list those things down here, and you're going to take it. You sure you're taking a double hit on it because you've already reduced it up above, and then you're reducing it again here. So you're kind of taking a double hit on that expense.
Right.
Which isn't correct. Or maybe you're leaving the expense off down here, to keep it clean.
Mm-hmm.
But don't do that. Keep it correct. Keep it the max. Another thing is if you're paying utilities and utilities are included in it, don't reduce out the utilities from the amount they pay. Keep that up in your rent, and then list under 17 the utilities. Correct. You're not going to get that added back in, but at least you've got the max rent up there to start with. Follow me?
Yeah, exactly.
And then secondly is depreciation is important to have correct. You need to have that figured out and calculated correctly so that you're getting the right amount of depreciation. I'm not going to get into that. There's plenty of great videos out there that you can. Toby Mathis, Clint Coons, they talk on and on about different types of accelerated depreciation and depreciation and doing I think it's called a depreciation survey or study, study to make sure that you're taking advantage of it. A lot of people don't want to do that because it costs money, but hey, if it gets your depreciation up and you're able to write more off on your taxes every year, I don't know why you wouldn't spend a little money to get one. And then that other, you need to make sure you itemize that other list and include it in and affiliate it with that proper page. Don't just list out, line 19 other and not put down which page and which property each line item goes to. Because when it comes time for me to try to add it back in, if I can't show the underwriter which one goes with which, they won't add it back in. They're not going to say, oh, well, 1 out of 20 properties or 1 out of 10 properties are this and that.
Right.
And this form you can find, if you do a search for it, it's available on the line. Online.
What's the form called? Fannie Mae rental income calculation?
Yeah. And this is for up to 10 properties. They have another one that is up to 4 properties. It's basically the same form, but less boxes. And I have just pretty much stopped using the smaller form. Sure, it's bigger, it's easier because there's only so many boxes. But so the reason why this is up to 10 properties is with Freddie and Fannie, the max number of properties you can have are 10 to qualify for a loan. So once you get to 10 properties, this is a good point that you kind of brought up without bringing it up. Once you get to 10 properties, you no longer can qualify for Freddie or Fannie. So then you're going to be moving into non-QM type loans and other structures and other type of financing.
Non-QM?
Yeah, so you're going to be using DSCR, debt services. You're going to maybe be using bank statements, tax returns, P&L statements, because more likely at that point you're starting to use LLCs and land trusts and different things to protect your assets. But for the person who's just starting to buy investment property, they're going to initially try to stay under 10 properties. And here's a little hint for you. If you're starting out with a family member, let's say your spouse, and you're starting to buy properties, don't put both your names on them. Buy one in her name exclusive, where you have no right to it, and then buy one in your name. Because then you can double the amount of properties that you own.
Right.
Before you run out of the 10 properties.
Yeah, because each individual, regardless of if you're a married couple, if you're not on as a married couple and you're individually on
qualifying. So if you can both qualify to buy a property, which even a homemaker can sometimes qualify, because if you're using the rent,
right,
you don't have a lot.
She has enough rents. I mean, it's a source of revenue, a source of income.
Correct.
She's on those rental properties, so she's like a property manager basically, even though she's a homemaker. Yeah.
Correct.
Understood.
So that's why it's important to properly structure your deals. And at first, most people don't think about that. So they'll go out and both the husband and wife will go on both properties.
Right.
And then they'll get to 10 properties and they'll be like, oh, we can't buy any more properties. And they're stuck because they're not just on the properties, but they both were on the loans.
Exactly. So it's not a quick fix.
Right.
Oh my Lord.
Because the issue is 10 financed properties.
Right.
So you could technically have 11 or 12 properties if 2 or 3 of them are free and clear.
Sure.
because they're not
Sure.
financed.
Sure.
So your max is 10 financed properties. Um, and so you kind of want to try to save those numbers. So when you start to do this, it gets into a trust thing, because one person is liable for that property.
Mm-hmm.
And if they were to get separated, title reads a certain way where the other spouse does not have any claim to it.
Right. Yeah, that's where the details, thinking through what you want to accomplish, maybe on a shorter term and mid or longer term basis, what the true goal is, and figuring out all the details, working with experienced loan originators and real estate agents and anyone else that helps accomplish those goals, from a CPA or a tax attorney, those types of things, getting that laid out before you actually start going makes sense. Now, but not overcomplicating it to prevent you from taking action, but.
Right. It's not going to hurt you if you do your first one and
Right.
you both put yourselves on it. It might actually help you down the road, because now you've got one property that's got income coming in, and then that helps.
Sure.
Maybe the spouse doesn't have the income to buy a new one, but now that she has this, it's pulling in some extra income that she can apply towards helping to qualify for the other one. The other thing is, if I knew back then what I know now, when I was, back when I was 18, 19 years old and I, ran away to college, I probably would have thought about looking at a multi-unit property to buy for myself in the college town that I was living in. So
Right.
if I was smart, and when I moved down to San Diego, I would have found, at that age, I didn't care where I lived.
Right.
I was looking for the cheapest possible thing. And I lived in some pretty, questionable areas.
Sure.
And instead of renting there, what I should have done was done a search for a 2-unit or a 4-unit, see if I could qualify for it and get into it, and then lived in one of the units, rented out the others while I was there. And then after I was done with school, move out and rent the other one, and I'd have a rental property. I'll tell you. So this gets into another thing, which is I see a lot of people that at 18 years old, they go into the military. And I think we talked about this before, but I'll talk about it again since we're talking investment properties.
Mm-hmm.
And so they join the military at 18. They get through boot camp. They go off to their first duty station, and this is a reoccurring thing I see in a lot of people that are successful that come out of the military. And they get to their first station and they bought a house or a condo or a 2-unit or a 4-unit, a 1 to 4 unit near the base. And they lived in it while they were there. They got subsidized housing from the base, because a lot of bases, you can't live on base, so they give you a little bit of money to live in town. So they were subsidized while they were doing that, and they lived in it for 2 or 3 years while they were at that base, and then they moved duty stations. So then, from there, they moved to another state. But when they left, they didn't sell it. And while they were there, they were saving up so that when they did move, they'd have some money to put down on their next house.
Mm-hmm.
And they found a real estate company, a property management company to manage that property, and then they moved. And the thing that's nice about it is there's always people coming to that base that are looking for a place to live. So it's usually listed at the base as, and available with a real estate agent that helps the people at the base. And they move to their next base, and then they start looking for, they live in temporary housing while they're looking for a house at that new base, and their old house is being rented out, and the rent is covering the cost or the majority of the cost of that property, right? At first, maybe it's not making money, but it's at least you're only losing, maybe you're only having to come out 20, $50 a month out of pocket, right, for a couple of years. But as time progresses, rents go up, but the mortgage stays the same, and so they have somebody renting it. So they move to that next base, they buy another property, they do it again, and they live in that for 2 or 3 years, and then they move to the next their next base, and they do that. And by the time they retire at 20 years, or maybe they get out in 10 years, they have two to 5 properties that for 20 years have been being paid on, and they're almost paid off, or they are paid off because rents have gone up and they've been aggressive on paying off the mortgage. And so they retire from the military, they leave the military at 20 or 25 years, and then they move into their next step of life, which is they move to either a local or state government, or move to the federal government to take a job. And then they find themselves a house to live in. So now they own 3 to 5 homes that are all making more money. Generally, by this time in their life, they've got income of about $15,000 coming in, $10,000 to $15,000 on those properties, free and clear.
Right.
Even if they still have mortgages, that's how much the rents have increased over that time period. So they're cash flow positive on all those properties.
Right.
And if I had gone into the military, I would hope somebody would have pointed that out to me. So if you're seeing this and you're in the military, you're thinking to do something like that, you can do it. Or let's just say you have a job where you're moving around all the time. It doesn't have to be the military. Maybe you work for a large corporation, and there's a lot of movement. You can you take an assignment in Michigan, then the next thing you know, you're down in the South, then you're in, wherever. Think about doing that too. But if you did that, or when you first left home and you got into college, or when you first left home, you bought the cheapest thing you could afford, that's what I would do, for these kids who are growing up now. I would look at trying to find something, and don't be afraid to buy into neighborhoods that are depressed, because over time, things change. And even depressed areas increase. And the nice thing is let's say you do buy it in a low-income area. If you move out in a couple of years, you could also look at what's called Section 8 housing that help pay for it. So that's another strategy for investment properties, which is, you put somebody in there who's got Section 8 housing, and they're being subsidized by the government. So your check comes in automatically every month. A portion of it comes in automatically every month from the government, right into your account, and then they spend the balance due that they have to pay.
Right.
Any other questions about this form? Oh, I know. This was the other thing we're going to talk about. Okay. So when can you, so how does this form won't help you when you're buying a property, right? So when you're buying a property, we look at income differently. If you don't already have rents on it, this is for somebody who's already had it for over a year, and it's being taxed for the full year. Follow me?
Mm-hmm.
But this is the other way we do it. So this is if you're under a lease agreement or a rental agreement. So what we would do is, so this property, we already said that we felt this property was renting at about $2,400 a month, right?
Sure.
So
Yes.
you would take the rental agreement, or if it's not a rental agreement, you could also use a market rent survey, I think it's called. And that's what you're going to have to get. So let's say you're buying a property and the property is currently rented for $2,400. When the property is appraised, we're also going to get a rent survey, a market rent survey on it also. And the appraiser is going to come back and say, oh, the rents in this area are, $2,500. So because the rental agreement is less than the rent survey, because you use the lesser of the two, you would put in 2,400 here, and you would get to use 75% of that, because we assume that there's a vacancy issue. And then we already know that the PITI on this is, the PITI is $1,295, and so it would be a wash on this property, and you would get a plus $505 towards your personal income to help cover other expenses.
Yeah, I can see how this would really, you go after those 10 properties and you manage it right, and all of a sudden you've got a good portfolio.
So this is where a lot of people think, well, how am I going to afford to buy this investment property? So
Sure.
let's say you're currently living in a house and you want investment property. This is how we would calculate. I just heard a beep. Did I disconnect from you?
Nope, I hear you.
Okay. This is how we would add this income in against that investment property that you're getting a loan for. Now, this doesn't always come out like this. A lot of times, let's assume that, you can probably double that right now. So let's say the PITI on this property is really 2,500.
And it could be negative, yeah.
It could be a negative. So let's say and the reason I'm doubling it is I know that these interest on this PITI that we have, his interest rates are in the 3s and the 4s, because he bought these properties back when rates were ridiculously low, and it's more realistic that the rates now have doubled from what he was. So
Sure.
that would basically double what is sitting there.
Sure.
So in this type of situation, then you would have $700 you need to cover that out of your regular income. So it would help you to qualify, but it wouldn't qualify all the way for it. So you would need another $1,400 to cover that at least $1,400 of income, personal income, or other income, to help cover that cost. Are you following me?
No, an additional $1,400 in personal income to cover a $700 cost.
So let's say, so when you're looking at the liabilities page on a 1003, remember, it shows, current rent or current housing payment. Then it shows your car payment is $500, your credit card payment is $300. You have an installment loan for a stereo that's $1,200, right?
Sure.
This would be another line item in there. Instead of the 2,500 showing there, it would show $700, because it's using a portion of the rent against it.
Right, I get it.
A dollar for dollar. So the reason why I'm saying you would need about another $1,400 to $1,500 in income is because when you're thinking about this, that's 50% DTI, right? You need double whatever the line item is on your liability, at least. Follow me?
To offset.
To offset it. And that's the advantage of using the rents on this, because you get a dollar for dollar reduction, versus we don't take this 20 or this 1,800 per month and put it in the rent. Here, actually, give me 1 second. I'm going to jump back here. I don't want to show my screen until I'm ready. Sorry. I'm going to pull up a 1003.
Give it to us.
Yeah, I just don't want to show client's information, so bear with me. Probably not going to show up right, but okay. So let's go car loan. Installment balance 25,000, payment 500, credit card
Only.
So that's the way those would show up, right?
Sure, yeah.
But if we were using, like, what a lot of people think is happening is mortgage. What did I say that was 2,500?
Yeah.
Yeah. So they think this is how this shows on here when you have this situation. This is the PITI, right? Or the payment.
Mm-hmm.
But really, the way this is affecting it is this payment has been changed. This payment has been changed, and I'm keeping this real basic because this isn't the way it shows on the form, but it shows in a different area. But to go to that, it would make things even more complicated. It's really, this is what is hitting your income is only the $700.
Got it.
So instead of the 25 plus the 5 and the 15, the 150, instead of, what is that? That's 3150. Instead of 3150 against your income, it's really only 1350 that's calculated again to your DTI.
Right.
And that's why it's important up here, because on these would actually not even be negatives. Instead, these are positives. And that's why it's important to have those months correct up above. Because if you remember, these were like 40 and negative. Some of these were negative and some.
Right. You're talking about the fair market months, or
correct. Months on Mark's rental days.
Yeah.
Actual rental days, right? So it's important to do that. Then you get into properties like this. Let's assume this was a multi-unit. So let's say you buy a multi-unit and the rents on that multi-unit, let's double this, right? So now you're at 4,800. And the mortgage payment on that is 32. You could be cash flow positive on that. So maybe you live in one of them. And really what you're doing is you're sitting at, you have to come up with 1,400 instead of 2,400. See that? Are you following me? Because you're not having to come up with the full, technically, in reality, you're even going to come up with less, because 2,400 from 3,200 is what? It's $800. So your share of that property would be $800. We're calculating it based off of a 25% vacancy loss, whereas, or 75% occupancy. But if you have somebody in there for 12 months, that's not really happening. So, but remember, if that thing sits for 6 months, you could really be hurting, and that's the risk. And that's why you want to make sure you have proper reserves, and you've got money put away for a rainy day in case there's a problem where you don't have somebody in the property for a while.
Right.
The other thing you do is you move into one, you fix it up, and then you switch. After it's fixed up, you rent that out. Maybe when you first buy it, you only have enough money to fix up one of the apartments or one of the units, right? So you fix the one up, you live in the one that's crummy, but you fix the other one up first. And then as soon as you get it fixed up, you rent it at max rent for the area, and you live in the other one while you're fixing it up. And then by that time, it's been a year, and maybe you get it fixed up, and then you move out and you rent it out, and now you've got your first rental where you're making max rents on it. I don't know if I overtalked that or it got boring.
So what would you say each unit is a valid amount of reserves to save before you go bonkers and get to 10 units? How many months of mortgage payment reserves?
Minimum 6, possibly 12.
That's just in mortgage payment reserves, not including any upgrades, because you don't want to use your reserves for upgrades.
And that's not just to cover your mortgage insurance. That's to include your taxes, your insurance,
Right.
your HOA fees.
Your whole housing costs.
If you're providing utilities, all that kind of stuff. Your liability, on top of that, you're going to want to have liability insurance too. Rental, renters insurance, rental property insurance on top of that to cover your stuff. The other biggest mistake that people make at time of refinance is they have really crummy looking rental agreements. So, because even though we're going off your tax returns, we still need copies of your rental agreements to see that they're rented. And the biggest mistake is they're not signed, or there's a lot of crossing out that just looks horrible. Keep it professional. If there's a typo or something on the rental agreement, don't cross it out and have people initial it. Just redo it and reprint it. Get the proper rental agreement software. Make sure you've got all the disclosures on everything that you're required to have to protect yourself. And then you can do only electronic signatures, that's fine, but just make sure that everybody has signed it that is on the rental agreement. So if it's your property manager that signs it, make sure he signed it on your behalf. If you only have one of the renters signing it, make sure the other renter signed it. For multiple reasons. You get into a legal battle later on and you need to evict them and you don't have signatures and stuff, it could slow you down.
Right. Very true.
Because, then it becomes, well, I never signed that agreement. I didn't agree to that. I'm not held by the agreement. So, and I know there's a lot of things in different states that say that, well, depending on the state, there might be rules that state that, oh, well, the tenant doesn't have to sign the agreement because acceptance of the property is acceptance of the agreement, or the landlord doesn't have to sign the agreement because it's signature by the tenant is acceptance of the agreement, and the landlord wouldn't give him the keys if he didn't accept. You need to make sure you sign it, because while the courts may accept that kind of crap, the lenders will not. The lenders will kick it back, and they will say, this isn't signed, get all parties to sign it.
Right.
And not having that thing signed the first time means that they have to review it another time. And conditions create more conditions. In other words, something that you could have easily gotten signed off the first time now has to go in, and it's not always the same underwriter that looks at that file. And an underwriter just doesn't look at the thing you're asking them to sign off. They go through and they review the whole file every time they get into it. And that's when they find, or just a difference of opinion, something that your initial underwriter was okay with, because maybe they called you and talked to you about it. Now this new underwriter gets in the file and they don't like the way that previous underwriter did it. So now they're saying, oh, this thing that you were previously accepted on, I'm not going to accept that. And now you're in an argument over something you shouldn't be in an argument over. So my opinion is have everything correct before you send it in and clean, so that you're not going back and get different underwriters involved or have an underwriter catch an error that they made. I mean, I'm not all for, I understand that if an error is made, it needs to be corrected, but also if they make an error, that's on them, not us. Why have it, maybe something that was a wobbler, one day they're in a good mood, the next day they're looking at it, they got in a fight with their significant other, and now they're grumpy, and they look at it, and that thing they were okay with the day before, they're not okay with. Or they don't like the way they calculated something the first time around.
Right.
So that's why it's important to not drag things out, and that's why I try to get people to get me everything up front before we submit the loan. A lot of times they're like, well, can't we just get to that later on? No, get it to me now. Let's get it done and get it signed off.
It's very important to have that information up front, because you don't want to commit and get all these people moving in a direction of, hey, we're going to own this house, and then details weren't provided up front that later on when they come blow the deal. And all the money and time invested, not just from the customer or the client that wants to buy the home, but all the other people that have worked on behalf of that client, mortgage, real estate.
Go ahead. And when you're getting into these complex loans, you need to make sure that everything that you possibly can do is done up front. It's not as simple as a regular personal purchase where you don't have a lot of assets involved in that. On this, like if you look at this, this is 8 different properties, not including their personal residence. And things get overlooked by everybody involved. And it's best to just get it all in, have it reviewed once, get it clear to close, and go. Another thing that you want to do, since we were talking about tax returns, is make sure you sign your tax returns. You want signed copies, signed and dated copies on your tax returns, because they will condition for it.
Right.
So when you get into these more complex loans with multiple properties, it's a lot of documentation to go through and review, as you can see here. And the more you can have your paperwork together and the most up-to-date paperwork, the easier it is for your loan to go through. So like in this situation, if you're trying to do a loan right now and you give me all of your November statements, but it's December, hate to tell you, we're going to be conditioning, they're going to be conditioning for updated, mortgage statements. So, give the most current. And then while the loan is going through the process, if new documents come, just send them in. So, like maybe we started in November and you give me your November statements, and then when December 5th or 10th comes around and you get all new bank mortgage statements for your properties, just gather them up and send them, whether I need them or not. Because chances are I'm going to need them, because what I'm going to need them for is to show that you made your last mortgage payment.
Right.
If not, then what we're going to have to do is we're going to have to order a trade line update for each property, and that starts costing $50 to $100 each one, and that just increases the cost of your loan. So it's better to just update those documents and send them to me. I'm not being lazy when I'm asking for them, because one, we don't want to go back to the credit bureaus and ask them to give updates, because it takes time and they can pull wrong information. Whereas if you've got an updated mortgage statement that's showing that you made your November payment on time,
Right.
that's awesome. Now we've got it. We've got two birds. We've got an updated document and we have updated proof of payment. What else? Oh, appraisal. So appraisal on these properties is going to be a little different than a normal house appraisal. You're going to also be getting a rent survey. So, the appraisal is going to cost more. It's going to be another $300 to $500 more for the rent survey. So you can figure anywhere from $7,000 to $1,000, depending on the type of property. If it's a single family, if it's a multifamily, you could be talking as high as $1,500 for an appraisal, because now you got multiple units and extra work and stuff. So just realize that that's something you're going to come out of pocket for during the loan. And then lastly, when you're doing stuff like this, make sure that you are not making any major changes in your life. Don't go and cut a check, a huge check to buy something new. You can wait 30, 60 days to get the loan done.
Right. Like buying 2 additional auto loans during your process. You don't want to do that.
And if you don't disclose that, that's fraud, by the way.
There's plenty of automobiles in the market. Plenty of automobiles in the market. You're not going to lose out. Trust me. I've been in that business for some time.
If you're in a situation, it just happens that you have a lease that's ending and you're going to have to do it. It is what it is. But make sure we know and we discuss it first to see if there's a way to push it off.
Right. Exactly.
Because if we can push it off another month or two,
sure,
we don't have changes. Because I guarantee you that new payment is going to be bigger.
And you can always do an extension on existing auto leases that are coming due, possibly up to 6 months if you communicate with the lender, your leasing lender, and that'll give you more than enough time to close out on these real estate transactions and then make a move after that.
Right. So. Because I can tell you, if you have to switch from one lease to a new lease or an old car to a new car, generally the payment on the newer one is going to be higher. So now that's going to affect your debt to income ratio. And we're going to have to disclose that.
Right. Right.
All right.
All right.
Anything else? Man.
I think we're good. No, we covered a lot of different areas in that little bit of the complexities, kind of high level and a little deeper on rental properties, non-owner, investment property, real estate. Yeah, it's all in the details and the experience level of whomever you hire to help you close your loan successfully. So.
Right. And thank you, Ricardo, for acting like you don't understand it and asking questions.
No, it's the podcast that we want to at least break it down so people understand it.
Right. All right. Well, like the kids say, I don't know, like, subscribe, even if you hated it, like it or dislike it. We don't
comment, like, subscribe.
Yeah. Tell us how dumb we are. Tell us we're wrong.
Or what you enjoyed about it, what you'd like to hear on the next
I'm
podcasts
a
coming up.
masochist. I must be because I'm in the mortgage business. So yeah, I'm okay with negative feedback too.
Right, exactly. All right, until the next time, catch us here.
Thank you.
Have a good day.
You too.